Good morning, ladies and gentlemen. It's my pleasure to welcome you on behalf of Duroply Industries Limited and SKP Securities to Duroply Industry Limited's Q2 FY24 earnings webinar. We have with us Mr. Sudeep Chitlangia, Managing Director, Mr. Akhilesh Chitlangia, ED and CEO, and Mr. Pawan Kumar Verma, CFO. This webinar is being recorded for compliance reasons, and during the discussion, there may be certain forward-looking statements which must be viewed in conjunction with the risks that the company faces. We'll have the opening remarks from Mr. Chitlangia, followed by Q&A session. Thank you, and over to you, Akhilesh.
Thank you, Naveen, and good morning to everyone. Wishing everyone a very happy Diwali and happy Dhanteras today. Thank you for attending our earnings webinar for Q2 FY24. We're happy to inform that for Q2 FY24, Duroply reported a revenue of rupees 83.29 crores, which is an increase of 10.8% from the same quarter, from the same period last year, from the same quarter last year, and 9.8% compared to Q1 FY24. We also reported a profit after tax of rupees 65 lakhs. Duroply, founded in 1957, for the last 67 years, we have built a strong brand in the industry. Duro is recognized across India for its high standard of quality that has been maintained over the years. We are present across the countries and are now expanding with a renewed focus. Last year, as you may be aware, we raised 28 crores in equity capital by way of preferential allotment of equity shares and warrants. In the month of October 2023, 212,754 warrants issued to promoters were converted into shares. The remaining warrants pending from the promoter group will be converted in the near future. On the business front, the demand for our product is very strong, as reflected in our growth. There are challenges in the industry, but we are on top of those issues and are taking all mitigating steps to take care of that. As mentioned, we had an increase in our revenue on year-on-year basis, closing Q2 at 83.29 crores, a 10.8% growth over last year. And for the half year ended, our revenue stood at 159.15 crores, up 8.7% from the same period last year. For the quarter, revenue from in-house manufacturing from our plant in Rajkot stood at 47.86 crores, which was down 9% on a year-on-year basis, but up 1.1% on a quarter-on-quarter basis. Revenue from contract manufacturing stood at 35.3 crores, which is a growth of 57% on a year-on-year basis, and up 23.8% quarter-on-quarter. For the half year ended, revenue from in-house manufacturing stood at 95.2 crores, down 3.8% year-on-year, and revenue from contract manufacturing was up 35%, ending at 63.8 crores. Our cost of goods sold compared to Q1 this year has been maintained through a mix of better sourcing, efficient supply chain distribution, and price rationalization. EBITDA margin for Q2 stood at 4.4% as against 6% in Q2 FY23 and down from 5.8% in Q1 FY24. For the half year ended, the EBITDA for this financial year stood at 5.1% as against 5.9% in the same period last year. On the sales side, our strategic decision to enter the mid-price market through our brand Tower continues to pay dividends. Tower sales grew by 70% for H1 FY24 over last financial year, same time. Sale of Duro brand improved with a growth of 3% for the half year. If we look at the quarter numbers, for the quarter ended September 24, Tower segment saw a rapid growth of 76% year-on-year and a 14.3% quarter-on-quarter growth. Duro product sales grew by 8% on a year-on-year basis and 8.4% on a quarter-on-quarter basis. Our marketing spend remained moderated at 3.4% of sales. To boost the sale of our premium products after significant research, we recently showcased Duro Advantage, 9 layers of protection on select premium products at Mat Asia exhibition held in Pragati Maidan in September. Overall, the response was extremely positive. This new initiative is being rolled out to the market in quarter 3, and we expect a positive response for our premium products for Duro thereafter. So results for this will be start coming in from quarter 4 onwards. In addition, the company has undertaken another major marketing initiative, the launch of Duro Beyond Blueprints, a podcast series covering design philosophy and journey of leading designers and architects from across India. The podcast is available on company's YouTube page, Duro TV, as well as on Spotify. I would now request Mr. Pawan Verma, our CFO, to take you through some of our numbers. Pawan, you're on.
Thank you, sir. First of all, good morning to everyone and wishing all you a very happy Diwali and Dhanteras. Let me take you through some of the key financials from the last quarter. For the quarter, our COGS stood at 66.1%, which is same as our COGS that was there in Q1 FY24, and 64% was there in Q2 FY23. This is largely on account of increased business from contract manufacturing, which contributed approx 23 to 24% margin as compared to 40 to 41% on in-house manufactured goods. In terms of margin across the two sources, in manufacturing, our margin is marginally improved to 41.5% in Q2 FY24 from 40% in Q1 FY24. For the half-year period, in-house margin stood at around 40.75%. Trading margin dipped marginally to 23.2% in Q2 FY24 as compared to 23.8% in Q1 FY24. For the half-year period, contract manufacturing margin stood at 23.5%. We also continue to see significant inflationary pressures on our raw material cost, though improved when operating parameters. Despite increase in cost, we have maintained our COGS margin through better cost control and initiative on marketing that allows for better sales of higher profitable SKUs. Our employee cost stood at around 9.9% of sales as compared to 9.8% in H1 FY24 and 9.5% in H1 FY23. Our debtors period for the quarter stood at 38 days of the sales. Our inventory days has decreased to 133 days of consumption from 140 days of consumption. Our creditor days has decreased to 123 days of consumption from 125 days of consumptions. As a result, our cash conversion cycle has decreased from 53 days in Q1 FY24 to 47 days in Q2 FY24. Our interest cost as a percentage of sales stood at around 2.3% of sales for the half year ended September 23. Our ROC has stood at around 9% as compared to 12% in FY23. Thank you.
Thank you, Pawan. And so our growth shows that our business model is resilient. We are confident that our growth journey will continue in the near future, and second half of the year should be better than what we saw the first half to be. The demand for our brand remains extremely strong, and the new marketing initiative that we alluded to earlier, we expect stronger growth and improved margins going forward. We are now happy to take any questions.
Thank you, Akhilesh. Thank you, Pawan. Friends, we now open the floor for the Q&A session. Anyone wishing to ask a question, request to raise your hand and we take it up. We have a question from Dilip Sahu. Dilip, please go ahead. Dilip, please unmute yourself and go ahead.
Yeah. Can you hear me now?
Yes, please go ahead.
So basically, a few questions regarding growth and profitability. I think we started the year with last year we had some 20-25% growth. I thought the stated objective of the company was to grow at twice the market growth, industry growth. So, however, it is kind of dipping. This quarter is around 10%, which is what most of the large players have done, 10 to 12%. So, can you, ideate on what is going to be the growth like for next 2-3 years in terms as a strategy? Is it that it will grow as per the industry, or is it going to be a faster than industry growth? That's first question. And if you can also break up the volume versus price. if you have taken any price increment, that is. That's the first question. Shall I ask the other question, or you can answer and I can let you come back?
I think if you can ask all the questions, it'll just be easier
Second
giving the
is
answer.
regarding profitability. Is there 4.5% profitability, and we are running a very tight ship, which essentially means that all our working capital and etc. are optimized. There is very little scope to reduce that. Does it mean that for our growth of say 20%, which is the expectation of the investors, how the funding is going to come? Are you going to increase the profitability at the expense of growth, or is there going to be some debt? With that 4.5%, you can't obviously fund a 20% growth, including working capital and maintenance capex and taxes, so that the math doesn't fall there. And third, in terms of the tower brand, is tower brand mostly outsourced in terms of manufacturing? And if how is, because it's almost like 6-8 months since you have started reporting the last I think annual report. How has been the reception in the market? Are you primarily positioning against the unorganized, non-branded? Is there a price difference between, what is the price difference between an unorganized plywood of similar quality with tower? If you can just elaborate on that strategy of having two brands, pricing, positioning, what market segment you are looking for. And the last one is in terms of distribution, is there any, in terms of particularly retailer touch points, has there been a quantitative significant shift in the last compared to last year, this quarter? These are my questions.
All right. Thank you, Mr. Sao. Yes, so we had indicated a mid-teens to high-teens growth. We are slightly below that at this point of time. At the end of H1 this year. I'm expecting Q3 and Q4 to pick up on the volume side. Some of the channel that distribution expansion activity that had to happen, it's running is slightly delayed, but we're still very confident that we'll get up to a mid-teens growth level by end of the financial year, which steadily puts us ahead of where the industry is growing. Coming to the EBITDA margin that you alluded to, you're right. 5% EBITDA margin, 6% EBITDA margin doesn't give enough margin for working capital growth as well as internal capex maintenance to happen at the same time. We're looking at what are the possible ways to ensure that the growth is funded and is sustainable as well. But I think that time will tell what the right path for us will be. Probably in the next couple of calls, we'll be able to give a more definitive answer the way the company is planning to move forward. Coming to the tower brand, 97 to 98% of the tower brand sales are from the contract manufacturers. So it's very, very insignificant quantity is manufactured in-house. In terms of price difference between the organized and unorganized sector, let me just explain a little bit about our industry. Let's just categorize the industry into three parts. Products that are sold above 100 rupees a square feet, 19 mm plywood sold above 100 rupees a square feet. The ones that are sold between 70 to 95, 99 rupees a square feet to the end consumer. And the ones that are sold below that, which is below 70 rupees a square feet. The ones that are sold below 70 rupees a square feet is where the unorganized sector largely operates at. So the gap between tower and the unorganized sector would be about 15 to 17% on price point. The reason we're seeing such strong growth in the tower segment is largely because the consumers' preference towards the branded segment is changing. As income levels are going up, more and more consumers are preferring okay, let me pay a little extra, but let me use brand's material because it gives them security and peace of mind. So that's where this growth is coming from. In terms of the future for this segment, because of course the number of demographically, this is a much larger catchment than what the premium Duro brand serves on the consumer side. The growth for tower for us will continue to be higher than what we are getting on the Duro side. So I hope that answers your questions. In terms of retail touchpoints, yes, our retail network is growing, but it's not at the speed at which we would have liked. But I think with the new marketing initiatives that we have undertaken, which is being rolled out in Q3, I think Q4 onwards and into the next financial year, we will see this getting charged up again and and growth coming from there. I hope that answers your questions.
Yeah, some quantitative, feel would have been better, but let's say for South and West, which has been your,
Right.
target areas.
Right.
Can you tell some, any marketing initiatives in terms of expansion, in terms of distributor
Sure.
appointments, etc.?
Sure.
That will give a qualitative, because
Yeah.
last quarter
Okay.
also we had a similar kind of a response.
Right. So South India for us this year has had a growth of 17% over last financial year, and West India is up 25%. East India is actually doing a little better than we anticipated. It's up at nearly 30%. Bangalore is one market where we are doing quite well now. We actually appointed a distributor end of last financial year, through whom we have added about 35 to 40 retailers under a distributor. That has fueled our growth, as well as we have just appointed our first channel partner in Kerala last quarter. So we are adding more channel in the southern part of the country, and I think it just takes a lot of time once you add new channel partners to nurture them and get the type of result that you're looking for. South of India is also a very brand conscious market, and is also a market which is very competitive at this point of time, with a lot of new brands expanding into the south of the country. So that's one bit of a challenge. Western India is growing very rapidly. In fact, for the tower brand, it's one of our fastest growing markets. That's what's fueling the growth on the western part, and we are adding a lot of channel partners. I think from next quarter we'll start giving you we'll make it a point to give a little bit more idea on the number of channel partners we've added geographically.
Yeah. Thank you so much for answering all my questions.
Yeah.
I'll come back if I have more.
Yeah, thank you.
Thank you, Dilip. Friends, anyone with a question, please raise your hand and we'll take it up. Dilip, in case you have some follow-up questions, you can please go ahead while others line up their questions. Mr. Sahu, please unmute yourself and go ahead.
I think he just not put his hand down.
Yeah, can you hear me now?
Yeah.
Yes, we can.
Just a suggestion.
Right.
As I speak, I have got 2 more con calls parallelly going on, which I have to go.
Sure.
It's a peak time, and every small and micro company comes last 1 week of, there's such a congestion.
Yeah.
And even though I have many questions, I would like to stay here and ask them. I've got a parallel con call going on. So please try to keep it at a time where people can attend, you try, just if it can be a little bit early, but even if it's like the last week of the time, you can make it maybe slide in the evening where people are a little bit, 11 to 4 is the most peak time, when everybody is having con calls.
Say a point's taken. We'll ensure that the call is held at a time which convenience all the investors.
Yeah.
Feedback taken. We didn't see it from your point of view. We'll keep that in mind next time. Thank you.
But overall, if see, as an investor, I'm not too worried about what is happening on a quarter to quarter, and in a market like home products, this keeps on happening. But you are a new company. I am a new investor in your company. As an investor, the broad thing I want to know is, over a 3-year period of time, are you going to successfully take market share, grow market share? That's that's the biggest question in the mind. And
Yes.
data is not enough there to make that assessment. And second is, are you going to grow profitably, or are you going to, kind of damage the balance sheet in the process? That's the second biggest question. I have basically these two questions which I'm trying to assess
Sure.
by attending all other your competitors, con calls or asking you a question. But somewhere, that clarity, as a management, I have complete confidence. I've been seeing what you've been doing in terms of marketing and sales and being very conservative. Your operating metrics are excellent. But, the basic question is, a company which is doing 300 crores with 7-8, even if 7-8% of operating margin, how will you compete with a guy who is 5 times your size, making 10, 12, 15% margin? Excellent. And both your large competitors, whether it's Green or is it Century, they are excellent in operating metrics also. So there is no weakness or a clinch which you can attack. So that's a basic question which is bothering me for last 3 to 6 months since I've been invested in your company.
Sure. So, Dilipji, just to give you a heads up on how we're competing in the market. So our brand is the oldest in the industry. So the brand recall is very strong. And the channel trade partners, whether carpenter contractors, designers, and our retailers, are very loyal, who've been with us for a number of years, even through our toughest phase. That's the strength that really drives us forward. And we're just working on our strengths, which is providing high quality products, working with our trade partners to ensure that their customers get the right solutions for their needs. It is a challenge with two such large players in the industry with significantly stronger balance sheet and operating margins, as you alluded to. But that's where the challenge we quite enjoy working with as well. I think there's a lot of opportunity there in the market. Some of the marketing initiatives that we have started undertaking over the last 1.5 years, which is what fueled our 50% plus growth last year, which is what's taking us forward this year as well. And we'll keep adding new innovations on our marketing side. I think being slightly smaller, it makes us a little more flexible and agile to be tactful in the way we grow our market. For the next couple of years, yes, you're right, 5%, 6% or 7% margins won't be enough to fund strong growth. It's simple mathematics. And we will be looking at the right source of funding in due course to help us with with that growth journey. But I really can't allude too much to that at this point of time. But be rest assured, we will be growing our market presence across India. There's a lot of open field where we can penetrate into, a lot of pockets of the market which is not being served by any of the large players. Those pockets exist, and that's what we're trying to get into. Of course, those are a secret marketing strategy, which I can't tell you too much about. But yeah.
Yeah, proper. Absolutely. Very reassuring, and thank you and all the best.
Thank you.
Thank you, Mr. Sahu. Friends, anyone with questions, please raise your hands and we'll take it up. I guess similar to Mr. Sahu, there are some investors who are attending multiple calls. So what I'll do is I'll share my email ID on the chat. And in case there are any follow-up questions or someone has any unanswered questions, please write to me. We'll take it up to the management and get back to you. Akhilesh, the floor is to you in case you have anything else to add.
I think we've alluded to everything, Naveenji, and I would like to thank for everyone who have joined the call today for attending our earnings call. Again, wishing everyone a very, very happy and prosperous Diwali. Our belief in India's story is that the home buyer segment, which is where our brand predominantly operates, we're going to see a lot of significant demand in the coming months and years. The strength of our brand gives us the confidence that we will grow and play a large part in the country's growth story. As we'd mentioned in our previous calls, our journey has just begun and there's a long, long way to go. So look forward to seeing everyone at the next earnings calls. And Navinji, that's about it. Thank you, everyone.
Thank you very much. On behalf of all of us at SKP Securities, I take this opportunity to wish everyone a very happy Dhanteras, Diwali, and prosperous New Year. Thank you, Sudeepji. Thank you, Akhilesh. Thank you, Pawan, for taking time out to interact with the investors. And we look forward to hosting you again for the next quarterly results. Thank you and have a wonderful day.
Thank you.